Hello, and welcome to Portfolio Matters Week 4 Weekly Update. It's been a very eventful week in the market and we've got a lot to get through. But before we do that, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Okay, Keith, do you want to update us?
Thank you, Richard. Okay, so events that caught my eye this week. First of all, Powell's comments regarding the continued weakness of the US economy and how did not intend to stop QE in the foreseeable future.
Did he give any indication as to how much QE going forward, Keith?
I think it was just a continuation of the current monthly bond buying.
Right.
I don't have the figures to hand, Richard. But anyway, Powell is in a difficult position at the moment because if he says that the economy is strengthening, that means rising interest rates. That's bad for the stock market. But in this case, his comments that he saw continued economic weakness, the market took badly anyway. So he gets blamed whatever happens.
He does indeed. But then, yes, the situation is difficult, isn't it?
January market sell-off has continued. FTSE now down on the year. And there have been extraordinary shenanigans going on in the US market. And we will be talking about the options-fueled rally in GameStop. In the UK, we've had further travel restrictions. Lockdown seems to be never-ending here.
Yeah.
There are rumours that we will be here until at least April. So, for travel stocks and airlines, that is all very bad news.
And that's all about trying to stop these various unknown variants coming into the UK, isn't it, in any numbers?
Yeah, absolutely.
To make our vaccination programme, to try and keep it as effective as possible.
Absolutely. And essentially, our battle against the virus is not going terribly well. And that these new variants, all the indications are the vaccine works, but less effectively as it did against the original variant.
I think there was just a question there in terms of what does one define as effective? Is it keeping people out of hospital or stopping them from dying? Because if it keeps people out of hospital, that does enable the economy to open up. And that is the key thing.
Yes,
with the
I agree.
Program.
Absolutely. But I mean, vaccination is entirely a good thing, but the economy won't normalize until people are allowed out of their houses.
Yeah.
Okay, so GameStop. For those of you who are unaware of this situation, GameStop is a US retailer with thousands of physical stores from which it sells video games. And obviously, it's had a poor COVID lockdown season. And also, it's in an industry that's in terminal decline as game sellers sell their wares digitally directly to people's PlayStations. And so the hedge funds have enormous short positions. They've sold the stock short in the expectation GameStop is going to go bust. And this is the chart over the course of the last week. So what has happened is that day traders have ganged together on Reddit and organized massive options buying in GameStop. And between them, they have forced up the share price over the course of the last week from its initial just over $40 to a high of over $480, at which point various hedge funds have lost so much money that they have had to close out their short positions, i.e. buy back the shares at these vastly inflated prices, and some of them are in deep trouble and have had to appeal for more funds because they've lost so much money.
So the irony here, Keith, is that the shares are still only worth what they were worth before the business is failing, and the massive increase in the share price doesn't improve the viability of the business, but simply a redistribution of wealth from hedge fund managers to smaller shareholders or traders. But if they then hold on to the shares at this elevated price, at some point the price will drop back down to whatever the business is worth, and they will lose whatever 90% or whatever it may be of the value of their holding.
Yeah, that is all absolutely true, Richard. But the thing is, it's a short squeeze. So they have bought these shares knowing that at some stage they will be able to sell them to the hedge funds at a much higher price when the short sellers have to buy the stock back. Yeah. So I don't know what the decrease in the short sale percentage is, but a lot of people will suffered a lot of financial damage from this short squeeze. Yeah. And also, this is basically collusion. These individual day traders are colluding to squeeze the price higher. Now, if this were financial institutions, and one thinks of, say, the Hunt brothers trying to corner the market in silver, then that would be a criminal enterprise. So I take this as an indication of how frothy the markets are, and all these day traders playing games, and the regulator is too scared to take them on, essentially.
I guess also it's a new phenomenon, isn't it? So the regulator is ill-equipped at the moment to start to address this issue.
Yeah.
And if you want to have a free market where people can trade freely, there's a balance to be struck. And if you try and say you can trade freely, but you can specify what you can't trade in, then you no longer have a free market. I also think there's a sort of an us and them. There's a small proportion of the population, the 1%, is viewed as being extremely wealthy, and I suspect a lot of people out there are thinking that they're fair game.
Well, I agree with you. You know, who's the victim? Hedge funds. Nobody has any sympathy for them. No, and actually, people like share prices going up, and they're squeezing the share price higher, you know.
Yeah.
So, frankly, if they were to squeeze the share price higher of one of my stocks, I'd be ecstatic and all for them. I'd be saying, what a marvelous thing they are. So, you know, they could just turn their attention to Tecmar or Goldplat. We'd be cheering them along. Anyway, so we will see what develops in this situation, whether there is any regulatory crackdown. But as indicators of market froth, so this is the volume of options in the US, and you can see that the number of traded options has absolutely exploded over the last couple of years. And, you know, this is another indication that, you know, there's a lot of market participation from day traders. You know.
I did read the other day, I read that apparently Nancy Pelosi and her husband have bought $1 million worth of call options in Apple, Disney, and Tesla.
Well, yeah, I don't think that would be popular in this country.
No.
And I thought this is extraordinary. So this is the relative flows of money into Bitcoin, which is the blue line, or gold ETFs, which is the white line. And as you can see, over the last 18 months, more money has flown into Bitcoin than it has into gold. And there have been various commentary about why gold has not performed as well as expected over the last 6 months. And this could be one of the answers. If you look at the shape of the two lines in the last 3 months, you'll see gold has come off. So the flows have been out of gold, but the flows into Bitcoin have been enormous.
Yeah.
You'll like that graph, Richard.
It's an interesting graph. I think the question is Bitcoin in a bubble? I think you've got a graph next, Keith, haven't you, which asks the question is a little bit later on, I'll ask the question about, is gold in a bubble?
Well, so while we continue on this, looking at panic euphoria and the frothy market. So this is the panic euphoria index from Citibank, and it is at the highest it's been since the dot-com bubble.
I think basically, Keith, we have to say we should be panicking about the euphoria because it's not a
Well,
good time.
I think we should be worried. I mean, the thing is, we don't know when it's going to peak, but, you know, the market is looking very frothy. So this is the Goldman Sachs non-profitable technology index.
So this is the share. This is the aggregate increase in value of technology businesses that don't make a profit.
Yep.
So they have gone up, let's say, threefold, from fourfold effectively from their mean for the last 4 or 5 years.
Yeah.
That's projecting a lot of shifts from loss-making to profit-making businesses.
Well, if you look at it from the lows in March, they're, you know, what are they? They're up fourfold.
Well, 5 from the lows in March.
Yeah.
4 from the sort of meanish figure of 2015 to 2018.
So some parts of the market are looking incredibly frothy.
Yeah.
Now, obviously, oil producers are actually down over this period. So it's not the whole market, you know, but some sectors of the market are definitely frothy. And if we look at margin debt, we'll see that it's been massively increasing. Again, reaching a peak or heading towards a notable peak. And whenever margin debt increases at this rate, it tends to come back down again. Basically, in order to justify those borrowings, then you need to keep on making profits in the market. The moment you can't make any profits in the market, then you need to withdraw the money and pay back the debt, which creates its self-fulfilling down cycle.
Yeah.
Now, this is on something completely different. It caught my eye. So this is the long-term interest rates in UK, Germany, Italy, and the US. So in the UK, we have the yield, 10-year yield going back to 1700. In Italy, it goes back to 1310. In Germany, it goes back to 1326. And what you can see is in all these charts, interest rates are at an all-time low. And so what I'm trying to say from these charts is that the financial conditions we're living through at the moment are absolutely unprecedented in history. And I would also note that these charts are quite strongly mean reverting. So whenever they spike either up or down over the course of the following years, and that can be quite a long period, prices will tend to revert towards the mean. Yeah. So you would expect these very low interest rates to head back, in the case of the UK, head back towards 3%, which is God say is the long-term mean, over some stage in the future.
It's quite interesting, actually, I think, to see the graph like this, where you see that the long-term mean for maybe, you're looking at the UK, from maybe 1825 to 1900, at about, I'm guessing, 3.5%. And since probably 1960, we've been used to interest rates of in excess of 6% for 40 to 50 years, and it's really only in the last 10 years, isn't it? The rates have dropped back down below what I sort of considered to be the bottom, which was actually 5 or 6%, but in reality, the bottom was quite a lot lower than that. It was 3%. So it's interesting how we sort of get programmed to accept what we're currently living in.
Well, absolutely. We each become anchored to the financial conditions we have lived through. But the other thing I would note, Richard, is that when you look at the UK chart, from the period 1700 to essentially 1972, we were anchored to the gold standard in some way.
Exactly.
So we had, although we came off the gold standard in
we had some form of monetary stability.
Yes, that's right.
Which we do not have now. There are no constraints on printing money.
Yeah.
No constraints on borrowing by governments, and there are no constraints on lending by commercial banks.
Yeah. So what that means, you'll notice just the increase in volatility of interest rates.
Yeah.
in the period
So
since
does
we've
that
been
suggest, Keith, that in order to get our interest rates back to those mean numbers, we need to move to some form of non-fiat monetary system?
well, we perhaps have a constraint of some kind on money printing. Anyway, something we will be returning to again and again in the coming years, I suspect.
And basically, what we need is constraint on politicians bribing the electorate with more and more financial promises.
Well, that's the reason we moved to independent central banks in the first place, Richard. It's just the reality is they've become co-opted into the system.
They're not independent, are they, Keith? They are reactive to the needs of politicians who are reactive to the wants of the electorate.
Well, they've become reactive to the wants of the stock market, for better or for worse. So the question that arises from all the charts we've just shown about market euphoria are, given that markets seem really toppy, will all markets fall at the same time? Should you be getting out of everything? Should you be getting out of, for example, gold? And if we look back to what happened the last time there was a stock market bubble in .com 2000, which is in the yellow square highlighted center screen, you'll see the green line is the NASDAQ. The yellow line is gold. And actually, gold was hardly affected at all by the crash in the NASDAQ. So I think you can say that the two are completely uncorrelated, actually.
I think they sort of represent different points of view, don't they? So the price of gold represents people who think the system is under extreme stress and they want some insurance for if it breaks. And the price of the NASDAQ represents people who think that the world is wonderful and they can't possibly lose money, and the current system is working incredibly well for them. They're going in the same direction, sort of, but they represent totally opposite points of view.
Yeah. Well, I think in the case of the NASDAQ, I wonder how much is just a self-fulfilling rally with people buying because they expect it to keep on going up. Yeah. Okay, so onto the checklist. Now, last week, I think the notable changes were that iron ore fell 7%. Copper was off a tiny bit. Oil was essentially flat, as was gold. Bitcoin has had a very good week and is up very strongly Friday morning. The all share was off, down 2.9%. The S&P was down, but again, we do record this on Friday morning before the open in the US. And sterling was essentially flat against the US dollar. So looking at iron ore briefly, it has had an incredible run. But as we talked about in our first couple of weeks of the Portfolio Matters, we were expecting the iron ore price to come back off because essentially there's vast amounts of iron, and the moment the price goes up, then there's always a supply response, and there's only a question of time before it comes back down again. So whether this is just a temporary blip back down, at some stage I would expect the iron ore to drift back down towards more normal levels.
Agree.
Richard, what's going on in Bitcoin?
There we are. So this is my graph of Bitcoin, and I think if you look at it, what's happened in the last since the beginning of January, we see that we've got what the chartists would describe as form of consolidation, and the spike up is within that consolidation. So I think it remains to be seen whether Bitcoin is going to continue on its upwards path and break through the $40,000 barrel barrier and continue upwards, whether it's going to sit in this consolidation range for longer, or indeed whether it's going to drop back down towards one of those moving averages. So I think the jury's out, and I find it really, really difficult to try and predict what it's going to do. I have a personally, I have a theory as about why the price is going up, and my theory hasn't been, as far as I'm concerned, my theory is intact. So I'm hanging on in there, watching with interest as the value of my small portfolio of cryptocurrencies fluctuates wildly.
Well, it's going up when everything else is going down, Richard. So well done. Okay, so moving on. Do you want to talk about your portfolio this week?
So my update is so my portfolio is down 5.3%.
Ouch.
That's ouch. Yes, I am used to the volatility of my precious metal miners, and this is a consequence of that volatility. The price of silver got whacked. Was it the back end of last week or beginning of this week? I forget which. Gold went, at one point silver was down 10% in the day. Someone clearly decided they wanted to knock the price down for their own purposes. And you just have to live with it. And so, which is why I tend not to, from my own personal point of view, I tend not to look at my portfolio on a sort of weekly valuation basis. But for the purposes of this exercise, this is how it looks.
Yeah.
Noticeably, yesterday and today, silver appears to be undergoing some sort of short squeeze or ramp upwards for whatever reason. So, and the prices of the miners are reacting accordingly. But we shall. I'm in there for the long term, and they drove my gains last year. So I'm fully anticipating, or at least hoping, that they will do the same this year. So I repurchased Pensana and Zinnwald, having realised that I might have made a mistake by getting out of them a couple of weeks ago. And my timing on Pensana was not good. This is, I sometimes I look at the Fibonacci retracement. I think it can be quite a handy thing to tell you where you are in the whole process. But basically, I sold Pensana somewhere around here, I think. I bought it back about here, and since then it's done this. But it's sort of a 618 retracement on the Fibonacci, so that's within the bounds of a retracement of a recent move. So I'm just going to sit there and wait. I use this it gives me a guide, Keith, a sort of an objective measure to see what the sort of proportion of the pullback is. So then with Zinnwald, I've this is the graph of the price of lithium carbonate, which I pulled off this morning. It's now $62,500 per
yuan, actually.
Yuan per unit, whatever a unit is. This is the one that I showed last week, where it was 54,000. So it's actually 15% up on the week.
Wow.
And I'm using this as my guide as to what to do is Zinnwald.
Yes.
And while the price of Zinnwald, it pulled back from 15 or so. It's around about, it's just here now. My view is if the price of lithium carbonate continues to go up, then the price of these shares will continue to go up as well. So I'm just sitting there holding these.
Okay.
I just pulled this off. This is the website I look at occasionally, and so I forgot to put the source on it. But this is as at the 31st of December, so it's slightly out of date. And it shows the total small business revenue normalized at January 2020 level. And you can see that after the initial lockdown with COVID and so forth, it rebounded to about minus 20%. And now it is basically in a gentle decline, which I think is very bad news for the US economy. I think it's very bad news for all of our economies, because I suspect it's indicative of the same processes happening in all of the developed economies. And will take quite a lot of recovering from.
So my activity, I was down 2.7% on the week, which takes me down to minus 1.6% on the year. So I've got quite a lot of gold, which actually acted as a hedge this week. And I only sold one thing, and I sold a bit of gold. And the reason that I sold some gold was I want to have some cash, because I think that some of the frothier stocks are going to come off, and I want some ammunition to buy some. So, for example, Pensana is in my sights. Looking at the share price, if the share price comes down enough, I'd like to buy some.
Yeah.
And the only stock I bought during the week was Capital. Now, those of you who have watched our video on Centamin will know that Capital was the beneficiary of a mining stability contract from Centamin to the tune of $250 million. And I'd never heard of Capital. And so I had a look, and a video is coming up. I think it's an opportunity. So I bought some, and I have some limit orders to buy some more.
Good.
And that's it, I think. So please watch out for some videos which are coming. One will be coming on Capital. I've also done one on platinum, on rare earths, and particularly neodymium, and also Sylvania Platinum, which is a viewer request.
And we're going to be doing one on lithium.
Great.
Sometime next week.
Great. So there's lots to look forward to. And so I hope you enjoyed that. You'll press like, subscribe to our channel, and we hope to see you again soon.
So it's goodbye from Keith Jordan.
And goodbye from Richard Wheater. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.